Very good evening to all who've tuned in to this special broadcast here live on Money Control. We are going to be discussing the state of the economy because we just had the Q1 GDP numbers that were released by the government a short while ago, and that print has come in pretty much in line with expectation at 7.8%. Now, we were seeing a range of, all the polls before this showed us ranges from right from that 6.5 to going up to 8.5. So we did know that this number would come somewhere comfortably in between, and it has done so. It has come at 7.8. Even the GVAs, if you look at that too, is coming in at 7.8. But the only one that one would have to look at more specifically is the agri output, and that one has come in at a 3.5 compared to the 4.4 that it was earlier. So there we will be discussing all of this in detail, and to join me to do that is Mayank from HDFC, as well as Mr. Manuranjan. Thank you, gentlemen, so much for joining me on this live broadcast. We just have a slew of data that has come in, not just the GDP number, but also fiscal deficit number that we're seeing coming in, as well as the factory outputs of 8 core industries. So a lot of data to unpack in this show, and we're going to be doing that one by one. So let me first go to Mr. Manoranjan and get your first view on this 7.8 number that we are seeing right at the top of it. It is in line. We've already established that. But what were we likely? This is also coming at that base effect that we are talking about. So try and break that down for our viewers. What really this base effect? Where is it coming from? Why are we looking at a 7.8 number? And is that a lot? Is that enough for us to be cheering about?
Yes, thank you for an excellent perspective. I agree entirely with you. The numbers are largely in line with our expectations. Most economists had penciled in a number of small range from 7.5, 7.6 to about 8.1 or thereabouts. Our prediction was for 8% number, so slightly less than what we had forecasted. So the numbers are largely in our expectations, and these numbers have to be placed in a proper global historical and comparative perspective. When you see that the world economic outlook has reduced the global growth projections to 3.5%, from 3.5% in 2022 to 3% in both 2023 and 2024, these numbers certainly seem impressive. What is more important also, that India has clearly emerged as one of the fastest growing, especially among large economies. But going forward, I think we, as you pointed out, because of the base effect, these numbers could come slightly lower in the subsequent quarters, ranging from 6.5% to about 6% or 5.7, 5.8% or thereabouts. There are also some other concerns, so possibly we could come to those concerns at a later time. My initial take is that these numbers are in line with our expectations. They clearly show that India is once again out of the ravages of COVID-19 pandemic, and going forward, we see India's position gradually consolidating at the global high table in the Committee of Nations.
Right. Mayank, if you have to come in here, and if you're looking like sir was pointing out that RBI has already, given these numbers. In fact, their projection for Q1 was 8%, and we're coming in at
Yes.
7.8. HDFC had pencil in the same very number. So are we likely to see this wear off, especially, given that inflation is that high, and, we have the government has to be taking steps on that front as well. Is this number and why are we likely to see this, trailing off effect that for the coming quarters?
Yeah, so first, let me say that these numbers are exactly in line with what we had predicted at 7.8%. But having said that, the story remains same, that as it was in the last quarter, it is about the resilience in the domestic economy, where investment has picked up and there is domestic demand. So it's not just investment. One worrying sign last quarter was that we had seen some slowdown in consumption. Consumption growth, I think, had come at around 6%, which is excellent which was around 2.8% last quarter, and now we are at 6%. So consumption is playing. Manufacturing growth has been good. So it is a story. Services have actually done really well, but having said that, in services sector there are some concerns around, where we are still behind COVID, where if we look at the trade and hotels data, which is, trade, hotel, communication and transport, that is basically, a bulk of your informal services sector. So that if we look at the Q1 of FY20, that is April March 2019, then we are still slightly below that number in real terms, even in this quarter. So there is some catching up to do there. But having said that, I think the story remains for the next few quarters, that this high growth number is on a lower base. As I said, that,
Right.
there are sectors, there are segments where we are still not yet fully out of COVID, if we look at just the level, before the COVID numbers. But in the going forward, we will see decent growth. RBI, our prediction is slightly below RBI, in the sense that we are saying 6.3% for the full year, and I think we will be on track to achieve that. But there are few headwinds, as you said, on inflation, that some part of it is transitory, but we see that government is already taking steps on inflation. We saw yesterday that there was prices were reduced for cooking gas.
Cooking gas. So
There
I
could
am
be
going
other.
to I am
Yeah,
going to come to that in detail to discuss this, because yes, we are also sitting, like, in an election year. So a lot of these
exactly.
fiscal measures might just go for a toss, if we have to say that, or rather the government might want to be more prudent and, try to prove a point. But going by how it's normally done, especially these populist measures that come in, Mr. Manoranjan Sharma, maybe you want to throw some light on what, beside, what are the measures the government could take, firstly to tame inflation, and also maybe not cross the line when they try to also woo voters at this point.
Well, as you know, the Government of India, in consultation with the Reserve Bank of India, they formulated the Monetary Policy Committee about 12, 14 years back. The Monetary Policy Committee, MPC of the Reserve Bank of India, has been mandated with the specific task of managing inflation at 4%, plus minus 2%. In the last few months, inflation was below that threshold level, but as all of us are aware, the July numbers came in at a high level of 7.4%. As the speaker from HDFC has already, there was a great deal of element of transitory nature, because vegetable prices, food prices, tomato prices, and these account for something like 30-35% in the food basket, but they have a disproportionately high impact on the level of retail inflation. They went up, but in the assessment of the Reserve Bank some time back, they made a comprehensive time series analysis going back about 25, 30 years, and on that basis they found that every 2 years you have this kind of a spike. Now, in coordination with the measures, I think in most parts of the country, tomato prices have fallen. I think there was a news item in the Delhi papers that maybe it is from a level of 200 has already dropped to a level of 15 rupees or 18 rupees, something like that, in some parts of northern India. So obviously, this seems to be well under control. Apart from that, this steep reduction in the prices of gas cylinders going forward, we do not see there could be some kind of a cut. Given the oil prices are ruling at about $80 a barrel, there could be some kind of a cut, or at least in any case, we don't see the prices of petrol and diesel going up. So going forward, I think these will be contained within the MPC band of 6%. 4 plus 2%. They could, but a little higher than this kind of a benchmark. These numbers could stay for some more time, and this will prompt the RBI to continue with the kind of a status quo policy, no change in the stance, no change in the key policy rates. That could continue for some more time.
Right. Mayank, also tell us a little bit about this agri number that has come. Is that a concern? Because that has come in lower at just about 3.5. We are hearing of, the El Nino really coming in and that setting in when it comes in terms of our rainfall, having quite a bit of deficit in the month of August. So is that also going to play out perhaps in the, quarters to come, and which is why we might see those numbers go back into those, 4 to 5% levels?
Yeah, see, first things first, in agriculture, I think 3.5% growth should be considered a healthy growth, because you cannot be comparing something which is your primary sector, and where you are technologically like penetration is less. So 3.5% is a good number, and if I look at the last year's number, it is at 2.4% for Q1. So we have actually done better if we are looking at the Q1 to Q1 numbers, and these numbers are actually getting realized because remember, we had a very good rabi harvest last season. So this actually represents the April to June number. What we are looking at, the El Nino and the Kharif season, so those the produce and the effect will come into the market in the subsequent quarters, and that is wherein lies the challenge. However, I think till 2 weeks back, the situation has worsened in the last 2 weeks. But till 2 weeks back, it was okay. It still remains to be seen. There is still some time for the rainfall, and we have seen in the past that Indian farmers have become adept and have become more flexible in terms of their sowing and how they do it. So we can still see the India numbers to be not as bad as it might look at right now. uh, that is one. The other driving factor would likely come from these stimulus that you were hinting at, that consumption related stimulus that government might be inclined to do given its election year. But having said that, let me just remind the viewers that in FY19, when the country was going into election, the government did maintain its fiscal deficit target, and they were not substantially off it. And this time they have other means, in terms of they have got a higher dividend than what was budgeted. I think it was budgeted was around 48,000. They have got some 80,000 crore from RBI, so they have some surplus there. The tax revenues have been better. Then some of the free schemes which was there during COVID, that has been rolled out. So that gives so government has enough in its coffer to stimulate the consumption, while keeping while being fiscally prudent. So I do not think they'll miss the target.
Right. Let's also talk about the other data point, the fiscal deficit number itself. Now, that one's quite telling because it's coming at 6.06 lakh crores, this versus 3.4 lakh crores. Now, this, if you look at it on a comparative basis, it looks quite a big number. It's almost 33% of the budgeted amount. So, is that gap really widening, and, quite a bit, we would have to say? On what really does that say? Like, the government will have to take in other measures to make sure that they do not cross that line.
See
Mayank, maybe
the
you.
Yeah, so that deficit numbers, you will see it has a significant bit of seasonality. So it is in the initial part of the time when you have a substantial part of your fertilizer subsidy going in, your food subsidy bill going in. So government has improved then, but I think the revenue bit is what comes later. So if you will look at it, the subsidy bill by October, November, by end of the calendar year, it'll probably go much higher. And then in the last quarter, when you get all the revenues in, then your deficit number comes down. And a lot of it, like I said, that the dividend and all those things, they get accounted for at the end of the year when you do your annual accounts. So I do not think we should read too much into that 33%, because I think government has enough resources, the revenues have been good, and if they can maintain, then economy is showing that we have the demand is resilient. So if the demand is resilient and the revenues are coming in, and your manufacturing and services is doing well, I think we are on a good pedestal.
Right. Mr. Manoranjan Sharma, maybe you would want to come in on India and the broader perspective. Now we are quite being that shining star, that bright star compared to the other emerging markets. So even if you have to compare them to developing markets, for that matter, when yesterday GDP numbers from US were pretty much in line, and they're still at that 2% levels. Of course, there's no direct comparison we can make, but how does India, how is it poised with this kind of growth momentum that we're seeing? Is it sustainable, and what really will perhaps take it forward?
Yes, certainly. Thank you for that very interesting question. We are clearly of the opinion, and I think when I say that, I think I speak for the very broad spectrum of economists, policy makers, planners, and even those at the helm of affairs, that this kind of a growth in GDP numbers is something with the order of 6 to 8%. We see a consistent growth pattern for going forward for the next 15, 20 years, unless there are some untoward events, some kind of a black swan event like the COVID pandemic, which was once in a century event. And nearest comparisons which come to mind are the Spanish flu of 1919. So going forward, we have already displaced last 2 3 months back Great Britain from the fifth place to the sixth. India is now the fifth largest economy. Going forward, within a span of 2 to 3 years, we see India emerging as the top three economies of the world. And by 2040, 2045, we could be one of the two largest economies of the world. Now, let me try to place, since it's an important issue, in a proper perspective. Traditionally, because it was held in the case of India and other emerging market economies, that population was some kind of a drag on the development process. But post October 2002, when for the first time Goldman Sachs, two persons authored that report, Dominic Wilson and Rupa Purushottam, that brought about some kind of a paradigm shift. Words like, expressions like demographic dividend, BRICS, young population, they have become part of the buzzword, part of the folklore all over the development discourse. So going forward, I'm confident that because of the demographic dividend, if you look at India's demography, we have 50% of the population of the country today below the age of 35. But as it was properly identified by the Goldman Sachs report also, going forward, while this kind of a 6 to 8% growth is here to stay on a fairly sustained basis, we must address some of the fundamental concerns of health, education, and employment. So these are real and fundamental issues, and if we can address them meaningfully and effectively, I see no reason why this kind of a growth of something in the region of 6 to 8% cannot be sustained for the next almost 20 years or so.
Right. Mayank, maybe before we leave, a last word on if there are any kind of externalities that can change this picture, or even, headwinds, if they are globally as well as in India, that could really derail us beyond, of course, like Sir was pointing out, major events like if there's a COVID situation. But other than that, do we have our books in order here so that, we can continue on this path?
Yeah, I think there are few risks which we should highlight. The external risk is there. RBI has been repeatedly highlighting the geopolitical defragmentation and the geopolitical risks. Those are coming in. Then agriculture, as I already highlighted in my commentary, that that poses a risk, and we see that some of the markers of rural demand. My presumption is that a lot of this consumption demand that we are seeing right now is driven by the urban sector. So the rural sector has been catching up initially, but of late we have seen some of the high frequency indicators where we have seen some contraction, like two-wheeler sales, which is a proxy because rural sector plays a big role there. We have seen that some sort of this inflation and high cost of ownership has led to two-wheeler sales. There has been a slowdown. Their tractor sales, there have been slowdown. So there are some markers that and with some of the capping of the exports,
Yeah.
some sort of restriction. So that will impact farm income, if you're putting some cap on onion exports or rice exports. So ultimately, that is going to impact the farm income. So in terms of that consumption, demand, and income, there are some headwinds. But as I said, on balance, government has enough arsenal in its firepower to, overcome it over the, next 3 quarters.
Right. So I think we can leave it at that word where the government does seem to be sitting comfortably right now. This 7.8 number is definitely something that they can perhaps tom about if they want to, because it is pretty much in line with what they have already penciled in. But we'll have to wait and see how the macro picture really plays out in the quarters to come, because those are the ones that are going to be really watched out more keenly. But for now, India definitely showing that being that bright spot, showing that it can grow amidst even that global gloom and doom. I'd like to thank my guests so much for joining in, Mr. Manoranjan Sharma from Infomerics Ratings, as well as Mayank Jha from HDFC. Thank you so much for giving us your time, and to all our viewers who've tuned in, thanks so much for watching.